But before we proceed with our question, for learning number 7, I would like to find out if there's anyone who didn't understand any kind of a section or a topic in the previous learning unit before we can continue to tackle our question on learning number 7. I'll give you just 1 minute to give you the suggestion, and then from there we proceed with our question. Okay, I can assume everyone is sorted. Then we can continue with our question 2 of learning number 7, whereby the subsidiary will be selling some of the depreciable asset and the parent will be selling the inventory. So it's just a mix of scenarios in a question. So this kind of the question that you can expect when you are writing examination, because they will give you a mix scenarios and then you have to tackle them one by one according to the way you mastered your topics in the prior sections. So let me open my Excel so that we can tackle the question together. And then I'll also share my Excel so that you can see my workings. Okay, please advise if you can able to see the Excel so that I can continue.
Yes, we can see.
Okay, now let's continue. We've got the question 2, whereby the question 2 is found on page 150 and 151 of our study guide. And then let's read the scenario so that we can able to understand what was happening in this question. We've got the abridged financial statement of G&L Limited, which is for the year ended 28 February 2008. Then we're given the statement of profit and loss and other comprehensive income. Then we're given the statement of changes in equity. And then our required on page 152, it stipulates that we must draft the consolidated statement of profit and loss and other comprehensive income for the year ended 28 February 2008 in accordance with IFRS. So when we go to the information, we are given the additional information which states that G Limited acquired 80% of the voting rights in L Limited on 1 March 2005. So our at acquisition, it will be 1 March 2005. Then the total value which G Limited paid, it was 250. And then L Limited was having the share capital of 100,000, retained earnings of 64, and revaluation surplus of 120 on the date of acquisition. Then we consider the carry amount of those assets and the liabilities of L Limited to be equal to their fair value at the date of the acquisition. On 1 December 2006, which is the subsequent years after the acquisition date, L Limited, which is subsidiary, sold a machine with a carrying amount of 200,000 to G Limited at a profit of 50,000, which that time L Limited managed to have a profit of 50,000. Then they tell us that it's the policy of the group to depreciate the plant and machinery at 20% per annum on the straight line method. So it means this machinery, they are valid for 5 years. And then 3, G Limited sold some of its inventory to L Limited at a profit of 50,000 on cost price. L Limited had the following inventories on hand, which they purchased from G Limited. So all the inventories which L Limited have, he purchased all of them from G Limited. So the opening inventory, it was 210, and then the closing inventory was 315. Then G Limited, which is the parent, lent sum of 150,000 to L Limited at an interest rate of 18% per annum, payable annually in arrears. On 1 August 2007, G Limited received and banked the check for interest for the month of February on 28 February 2008. The interest did not qualify for capitalization and was accounted for by both companies. Now, we're gonna draft our analysis of shareholders, which it will be the one for L Limited. Then we have question 2. Then we're gonna start with our analysis of shareholders. For L Limited. Then first, let's tackle our scenario so that we can be able to know, does our analysis have 3 sections or 2 sections? So our acquisition date, the acquisition date is 103 2005, and then our since acquisition to beginning of the current year will run from the 2 of March 2005 to the 28th February 2007. And then our current year will be 103 2007 to 28 February 2008. So it means our analysis of shareholders will have 3 columns. So we're gonna have at acquisition, and then while on the other side here we have a total, we have since, and then we have the NCI. So on the date of acquisition is whereby we have the share capital of G Limited, of L Limited, share capital. $100,000, and then they told us that the voting rights is 80%. It means on the date of acquisition. So here we're gonna have the add part. So here it will be the 80,000 because the voting rights is 80%. 80,000, and then our NCI will sit on 20,000, and then our retained earnings as shown in page 151 is sitting at 64,000 on the date we acquire the shares, and then the 80% will be 51,200, and then the NCI will be the 12,800. Then we got the revaluation surplus. Our revaluation, it was made for 120. And then our percentage perspective will be the 96. And then the difference will be the 24. I believe everyone have a clear picture of what's happening here. It's not a train smash this side. Then we have to sum up the total of the at acquisition date, which they give us the 227,200. And then now there is a consideration paid by our parent, which is delimited. The consideration paid as shown on page 151, they said they paid an amount of 250,000. So we paid 250 in order to acquire Limited. So as a result, we acquired Limited with a bargain. So we're gonna have a goodwill. It was based on the good business that he was doing. So we have to have a goodwill of 22,800. Then now we're gonna go to this part of the since acquisition to the beginning of the current year. Now on our since acquisition, to beginning of current year, and as I mentioned earlier, that the reason you're gonna have the since acquisition is because you are being guided by the dates. As I mentioned those dates earlier, so these dates are the one guiding you how do you draft your analysis of shareholders, together with the retained earnings. If you have given the retained earnings at the beginning of the year, as shown on statement of change in equity, so it means we can have it since acquisition to the beginning of the current year. But if we were given the retained earnings at the end, so it means our analysis was going to have only two sections, which will be the at acquisition, and the last one will be since acquisition to the end of current year, because our retained earnings will be given at the end of the year. But in this case, the retained earnings is also given in the beginning of the year, and which is correspond with our dates that we've mentioned here. So it's where we're going to have the analysis with 3 columns or 3 sections. Now, the transaction number 2, it happened on 1 December 2006. So it happened somewhere along the way in this section. 1 December 2006, it falls here. It was after the 2 March 2005, and it was before the 28th February 2007. So it happens here. So we're gonna record that transaction in this part. But before we go there, let's tackle the retained earnings. The retained earnings that we have, we as G Limited, we as the L Limited, we have the retained earnings of 44,000, as shown in the statement of changes in equity at the top. We have 44,000. However, before we had the 44,000, our retained earnings was sitting on 64,000. So it means somehow we made a loss. So we're gonna say the current balance, which is the beginning balance, is 44,000. Then we less the balance that we had before on the date of acquisition, which is 64,000. So as a result of that, we have a negative figure of 20,000. So we're going to put that 20,000 as a negative because we made a loss. Then we as L Limited, we sold a machinery with a carrying amount of 200,000 to G Limited at a profit of 50,000. So we as the L Limited, we realized a profit on 1 December 2006 when we were selling the asset to G Limited. So we have to record the unrealized profit. So based on the information that I've shown earlier on the prior classes, I did do the summaries of the unrealized profit. So tell me if you can able to see my Excel whereby I'm showing the summaries, not the one of the workbook, the one I'm doing the calculation of question 2. Can you see the Excel that I'm referring to? A response,
No.
please. No, okay. Let me try to reshare it. It will be the one on this one. Can you see this? Can you see it now?
Yes.
Okay.
Yes.
Remember last week I did the summary of this. How do you draft your thing? So in this case, we've got a subsidiary which is selling the depreciable asset to the parent. So, and we are required to draft the statement of profit and loss. So here we're gonna have a depreciation. Like let's start here. The unrealized profit will be realized during the following subsequent years according to the depreciation model. And then the unrealized profit will affect the SFP on the cost part. And then the realized depreciation on the profit will affect the face value of the SFP on the accumulated depreciation. But in this case, we are not, the question we didn't want anything to do with the statement of financial position. Now we have to go to the SPL part. So the realized depreciation on profit will be deducted from the admin expenses. So suppose there is an admin expenses, you're gonna deduct the realized depreciation, which I'm gonna also show it, because in this case we've got that kind of a situation. But it's only when we'll be drafting the consolidated statement of financial of a profit and loss for the group. But because now we are only tackling the one for an individual on the analysis of shareholders, the unrealized profit is going to be deducted in the individual statement. So I can edit here. Unrealized profit will be deducted in SPL when we deal with individual. So suppose when we were drafting the statement of profit and loss for L Limited alone. So since we have an unrealized profit of 50,000, this 50,000 need to be deducted in the particular year that they will be tackling that profit. So the profit was realized between, I'm gonna go back to my initial one, the one whereby I'm dealing with the question. Just hold on when I'm sharing it again. So when we are tackling this, the unrealized profit was done in this year, the one of the year between 1 March 2006 up to the 28th February 2007. So that particular year, when we'll be doing the unrealized profit, we're gonna deduct it here. So we're gonna have the unrealized profit as a result of the selling of the machinery. So our unrealized profit will be minus 50,000 because it's the year which we sold the machinery. So the profit is not yet realized because the profit will only be realized when our parent starting to use the machine. So immediately when he start to use the machine is where we can realize the profit, or the profit can be realized if suppose we sold the machine to G Limited and G Limited take the same machine and sell it to E Limited or to a part or to any company outside our group. Then we as limited, we have to realize the profit there. So our profit, which it will be unrealized, it will be the minus 50,000. Because at that time we sold it, but we assume that he didn't start using it yet. So we have 50,000 as a minus. Then now, if you can go to page 157, they said depreciation adjustment. That depreciation adjustment actually is a realized profit. So now, because we sold the machine on 1 December, so let's here on 1 December, machine was sold to G Ltd. Now, on the same date, from 1 December, up to 28 Feb 20.7, G Ltd will be using the machine for his own trade. So the minute he starts using the machine, we as a limited, we have to realize the profit, because I said a profit can be realized through use of the asset or through sale of the asset. So suppose G Limited decided to sell the machine to any company outside our group, we have to realize a profit. So in that case, we were going to realize the whole profit of 50,000 because the machine has been sold, all of it. But in this case, because the machine was not sold, instead it's being used. So the usage is not once off. The usage is a continuous thing. So our depreciation is going to be realized only through the usage, which it will be based on the continuation basis. So since the use will be happening from 1 December 2006 to 28 February 2007. So that duration of those months is where we can realize the profit. So the realization of the profit will be as follows. Realization of profit will be, we made a profit of 50,000, so it will be 50,000. Then we multiply by, we realize it through the depreciation rate, because the depreciation rate is 20%. So we have to realize by the 20%. Then we multiply by the months. The months, it will be from the 1 December up to the 28 February. So that portion, it will be the realization of the profit, because now we assume that G Limited is using the machine. So the remaining period, it will be realized in the future years, because we assume that G Limited will continue using the machine in the future years. So in this case, for the current year, the one of ending 28 February 2007, G Limited used the machine from December. So it will be December, it will be January, and it will be February. So for that 3 months, it will be the realization of the depreciation for a period of ending 28 February 2007. So it will be 3/12. So in that case, the profit to be realized back in our group, or I mean in our business as individual, it will be an amount of 2,500. Do we all understand this part, the realization part, especially based on this thing that I've drafted here? Do we understand it? I will also need a confirmation. I must not assume. Okay, the silence means everyone is understand. Then I continue. Then we have the realized. This will be a realized profit. In the study, they call it an excess depreciation. So we are realizing that depreciation which was used by the parent company, which is G Limited. So realized profit will be the 2,500. So since we are realizing the profit, we have to add it back, this profit. We're no longer deducting it because remember we deducted the unrealized profit, but the realized profit need to be added back on the face value of the SPL of the individual. But of the group is whereby we're gonna have to deduct the 2.5 in our admin expenses. Then the realized profit is 2.5. Then we can add all this together. Then when we say our minus 20,000 and which will be 70,000, that 70,000 plus the 2.5, then it will give us the minus 67,500. I guess everyone is happy then. Then we have to apportion it according to our columns. So on the since acquisition, we're gonna have a minus of 54,000, and then on our NCI, we'll have the minus of 13,500. Then we continue further. Now we're gonna have the current year. So on the current year, we'll have a profit for the year as an individual. The profit for the year, we have to calculate it. Now, when we check the statement of profit and loss on page 150, we have the given balance of 64,690. So we're gonna have that value, which will be 64,690. Now is the realization of the profit, which they can call it an excess depreciation, but that time we are realizing the profit. So the realization of the profit, as I have mentioned, that it will be realized bit by bit, not all at once, because all at once is only if the asset was sold. But in this case, because the asset was being used, so we have to realize a bit by bit. So realization of the profit which now it will be based on the current year, the period of 103 20.7 up to 2802 20.8. So now we are realizing the profit of this year, of the current year. Now on the current year, it will be the full 12 months. So the profit was 50,000, then times the depreciation, which is 20%. And then we have the value of the 10,000. So our 10,000 here will be added back because we are realizing the profit. As I have mentioned, the realization of the profit is an add, but the unrealized is a minus. So now since we had the profit of 64, and then we add it to the 10, then we'll have the 74,690. And then we do our percentages based on the 80% is 59,752. And then we do on 20%, it will be the 14,938. Now we can say we are done with our analysis of shareholders. So our total here will be the 313,990, and then we have the 5752, which because here it was minus and here is a plus, then it's 5752. Then here it was the minus 13.5, And then we have a 4938, and here we had a positive figure of 56,800. So the total here will be sitting on 58,238. Then we close. Now, since we did this, now we have to do the pro forma journal, whereby it will be the elimination. The pro forma journal for elimination purposes. Then we have a DR, and we'll have the CR. Now we eliminated all the intra-group. So the elimination that I'm going to focus more will be the one of the share capital. I'm not going to dwell more on it. We all know about it because it will be, we are eliminating everything that happened here. Whatever happened here, it needs to be eliminated, which we have the 100, the 64, the 120, and then the 2,800 is the goodwill, which is now becoming the asset because we're going to realize further. So we're putting on the debit side, and then the 250 is the investment, which was paid, and then the 56.8, it comes from here. So the first part of the pro forma, it comes from this bit. All this thing is the one which they're going to do your. Then I'm not going to focus more on it. So I'm going to go to the second part of the retained earnings. So initially, the profit, we know that about the profit increased the retained earnings. Or the profit increased retained earning. And initially, the retained earnings increased on the credit side. So now, because we are eliminating it, we're going to have the retained earnings because we are decreasing it. The retained earnings will be on the debit. Which initially was increased by the 50,000. Now it must be deducted back by the 50,000. And then the reason why, what causes the retained earnings to increase, it was because of the selling of the machinery, which it will be also the 50,000. And then we go further. So as a result of that retained earnings, so the depreciation also increased somehow. So the depreciation was increased by the 2,500 as a result of the machinery in the books of G Limited as the parent. His depreciation increased by 2.5. So now we want to eliminate it. So initially the accumulated depreciation also increased on the credit side. So we're going to say the accumulated profit, accumulated depreciation, it's going to decrease by the 2.5. The 2.5 comes from the one of this part, the one which was realized in the prior year. And then we're going to have the 2.5 here, which is as a result of the retained earnings. Okay, if someone have a question, because me, I'm busy sharing the screen, I'm not going to be able to see all these questions. So I'll advise someone just to notify me that there is a question raised. The question which was asked by Grace regarding the previous recordings. The previous recordings are found on the link. The link that you used to access the class is where you can also find the previous thing. You can also find the previous recordings. Then the retained earnings is 2.5. So the reason for this is because we are eliminating the profit which was realized through the usage of the machine. Then we've got so this is based on the prior year. Which is that period of 1/12, 20.7, the date which the machine was sold, or 20.6, sorry, up to 28/02, 20.7. That is this part. Now we're gonna do the same thing because now we're gonna eliminate the profit realized during the current year. So we still have the same kind of a journal. Accumulated. Deep, which will be the 10,000 here, and then the 10,000 on the credit. So the reason for this is because of the retained earnings increased as a result of the machine being used in the current year. Now, we were told that on transaction number 3, that G Limited sold some of its inventory to L Limited at a profit of 50,000 on cost price. L Limited had the following inventories on hand, which purchased from G Limited. So on 28th February, we have the opening balance of 210, and then on the closing, it was the 315. So there will be the profit associated with this. There will be a profit associated with this selling of the inventories. So the 210 multiplied by 50 divided by 150, it will be the 70. And then another one, 315 times 50 divided by 150, which will be the 105. So on 28th February, we have the unrealized profit from the 315 of the inventory, which was sold by G Limited. G Limited had unrealized profit because that inventory was not yet sold to any other person by L Limited. So this unrealized profit will have to be deducted because normally the profit was going to increase the retained earnings, but now because it's not yet realized, it needs to be deducted. So our cost of sale is not yet, the inventory was not yet sold. So it means we are still sitting with the cost of sale because normally the cost of sale, it's going to increase on the credit side. So now we have to deduct it because the inventory was not yet sold to any individual outside the group. So, and our inventory was going to increase on the debit side because this inventory that we still have, the 350 is the inventory that they still have on hand as G Limited. So they have to eliminate that inventory. So the profit associated with that inventory need to be taken out. So we're going to have another journal whereby we're going to have our cost of sale and then the inventory. The inventory that is sitting in the books of G Limited. Because it's not yet, the G Limited sold the inventory to L. So now the inventory is sitting with L at that point. So it's not yet sold. So it's the inventory of L Limited with the cost of sale because the inventory was sold by G Limited. So this comes as a result here. Let's break it down. Inventory on hand in the books of L Limited on the 28th February 2008 equal 315. So there is inventory sitting in our books as L Limited. So this inventory is not yet sold to any individual outside the group. So it means we have an outstanding inventory on our books. So there is a profit which is realized by G. So G realized a profit of, which we have to calculate it and see how much profit was realized by G Limited. So it will be the 315 times 50 divided by 150, because they told us that the profit of 50% on cost price. So the cost price is 315. So they have to realize a profit of 50%. So it will be the 315 times 50 divided by 150. So it gives us the 105. So there is a profit of 105. So this profit is up to now is not yet realized because the inventory was not yet sold to the outside parties. We as L Limited, we still have this inventory in our record. So the profit is unrealized. So since we have the unrealized profit, so it's gonna reduce our cost of sale, the cost of sale of G Limited, because G Limited incurred the cost of sale, but it's not yet realized. So you have to deduct that cost of sale. So the cost of sale initially was gonna be on the credit side as an increment, but since it's not yet realized, so it's gonna be deducted by the 105,000. And then the inventory, we as L Limited, we are sitting with inventory of 315 at the end of the year because we didn't sell the inventory. So inventory increased by an amount of 315. But because it's not yet sold and there is a profit realized by G Limited, we have to deduct that profit in the value of the inventory. Out of that 350, we have to deduct the 105 as a profit. We'll realize it later in the following year when the inventory will be sold to the individual outside the group. So since we're gonna deduct this profit, it means our inventory is gonna decrease by 105. So since the inventory is decreasing by 105, we have to record it on the credit side of our journal. Then we proceed further. Then we have the retained earnings and the cost of sale. So this one, it will be based on the profit realized as a result of the inventory sold to the people outside the group. So as a result of the profit we realize, so it means when we realize the profit, our retained earnings increase. So the retained earnings, when it increase on the credit side, but because now we are eliminating it, we have to record it on the debit side. So the retained earnings on the debit side, and then there is an increase because of the profit. So the profit came as a result of the sale which was made by G Limited when he was selling his inventory to L Limited. So this came as a result of, there was an opening inventory when we check on our adjustment. There was an opening inventory on 28th February. The opening inventory So the opening inventory is based on the closing inventory of the prior year. So the opening inventory was sitting on 210. So now this inventory is sold to the people outside the public. Outside group. So since now the inventory is being sold to the people outside the group, now we have to realize a profit. So when the profit is now realized, it's gonna increase the retained earnings. Hold on. As a result of the profit realized, a retained earnings earnings will increase. So normally when the retained earnings increase, we record it on the credit side because now we are eliminating it. That profit, we have to record it on the debit side. Now we have to check how much profit was realized on that inventory. The inventory was 210 at the opening. Now we sold it to the public. We made a profit of 50%. So we multiply by the 50% and the markup on the cost, which will be divided by 150. Now the profit realized will be the 210 times 50 divided by 150, which would give us the 70,000. So now the 70,000 will come here. Our profit was in the retained earnings was increased by 70,000, but because now we are eliminate it, we have to debit our retained earnings by the amount of 70,000, which is the one which was increased by the profit made by L Limited when he was selling the inventory to people outside the group. And then the cost of sale incurred by L Limited will now be eliminated by the 70,000. Is there anyone who have a question up to so far? I assume that no one is having a question. Then we can continue. Then our cost of sale will be the 70,000. Then the journal here is the elimination of the realized profit during the current year as a result of the selling of that inventory to the people outside the public. And then the 13,500, I'm not going to dwell more on it because it comes from this portion. The 14,938 comes from this portion. I'm not going to dwell more on it. And then now we have the loans. So if you can check on example, on adjustment number 3, they said G Limited lent sum of money of 150 to L Limited. So here we have G lending money to L for 150,000. So loan received or loan paid by G Ltd is 150. And then loan received by LTD is 150 also. So when they were doing their journals alone, we're gonna have a journal of, let's do the journal of G Limited, LTD individual journal, LTD. He had loan on the debit side, to be DR and CR. He had a loan of 150, and then he had the bank of 150. And then that's the journal for G Limited. Now we have the journal for L Limited. On the L Limited, we had the bank on the debit side of 150. Then he have a loan on the credit side of 150. So our elimination will be based on the loans. Hold on. Will be based on the loans. So this are the one to be eliminated. Someone is Peggy, please mute. Peggy, thank you. And let's continue. So since we have this is the elimination that need to be done. So the loan payable by G Limited, it was 150 on the debit side. Now it must go to the credit. And then the loan received by L Limited, it was 150 on the credit. Now it must go to the debit as part of eliminating the intercompany loans. Now we will say on the debit side, it will be loan from G Limited. So from G Limited will be this one, because here it was on the credit, now it's gonna go on the debit. So that's why I encourage people, when you want to do the elimination of the intra-group transaction, first do their individual journal alone so that you can able to know which thing to eliminate. So now we're gonna have loan received from G Ltd. So in the journal of L Ltd. Sorry, Ltd. So on the journal of L is this one. So on the journal of L, he accounted loan on the credit side because he was receiving the loan from G. So that's why now, because we are eliminating it, since it was on the credit side on his individual journal, on the consolidated journal, it must now go to the debit side. So on the debit side, we're gonna put the 150. Because these names, they are important. Because if you mix them up, they're gonna put you wrong when they mark, irrespective of that is 150 here. But for the fact that you use the wrong intra account, then we're gonna put wrong when we're making this amount of 150. Then on the credit side, we can also have 150, but the 150 now will be coming from here, this part, because initially here it was on the debit side. Now it must go to the credit side. So we're gonna now say loan paid to L Limited. And then in the books of who? In the books of G Limited. So it's 150. So the journal or the narration will be elimination of intra-group loans. Anyone who have a question with regard to this elimination of the loans, referring to this thing that's done on the side. Anyone have a question? I assume that no one have a question, then we can proceed. Then we are done with this journal for elimination of the loan. Now we're gonna do the interest part, which will be the similar thing. So in this case, G Limited granted a loan to L. So as a result, L is the one who need to pay the interest to G. So the interest, they go on the credit side as a part of an income. So it means in the books of G Limited, he will have a bank of whatever amount, we don't know the amount yet, we'll calculate it after. And then he will have the interest received because it's the interest is receiving from L Limited. Interest received. And then which it will be also XXX. And then on the journal of L Limited alone, he will have interest payable. And then on the credit side, you will be paying those interests via the bank. So now let's calculate the amount which must be charged as those interests. The amount will be, the loan made was 150. We multiply by 18%. And then multiply by the months. The loan was done on 1 August, and then the financial year is ending on 28 February 2008. So it will be August, September, October, November, December, January, and February, which is 7 months. So we'll say the 150 times 7 divided by 12, then times 18%. So the interest to be charged or for that duration will be 15,750. $15,750. So the 15,750 is the one to be plugged where I put the x-axis before. So here should be the 15,750 and the 15,750 here. Now, the elimination will be based on interest part. So we're gonna eliminate this. And this. So now the interest received was on the credit side. Now it must go on the debit side. So the payable was on the debit side. Now it must go on the credit side. I hope it makes sense, this elimination. So now we're gonna say the interest, we had interest received on the credit, now it must come to the debit. The interest received, it was received by who? It was received by G. Coming from who's coming from the L part, and then which it will be debit 15,750, and then on the credit will be the 15,750, which it will be the interest paid. The interest paid was on the debit. Now it's gonna go to the credit because of elimination. So here it will be the interest paid. The interest was paid by who? It was paid by L Limited. So we say interest paid, then we put L Ltd. Then it's 15,750. But suppose you didn't understand this and then you said interest paid and then you write G Limited. So this amount was gonna be wrong when they mark. And here we said interest received instead of G, and then you said it was L, then it was also going to be being a wrong. Anyone who have a question up to so far with regard to the pro forma journal, especially with the calculation of the interest versus the loans part and the profits? Tandega, do you have a question?
No question in terms of the journal, Mr. Molepo, but I'm just interested to know, had we been doing a statement of financial position, how would it look in the liabilities?
Okay, in the liabilities, since we're gonna have the loan was 150, because we eliminate them. So it means on our loan part, remember, you consolidate after you eliminated. So since these are gone, since it's gone, so it was not gonna be shown in your thing, in your SFP, because you eliminated them. I don't know if it makes sense there.
Okay.
Yeah, because since you eliminated them, then they are no longer shown. They are gone. Because remember, it means you're gonna have the loan from G Limited the loan to G Limited on your liability as 150, but on the asset it must be the loan from. You see, like this is a contra account, so they deduct each other.
Okay.
Yeah, so that's why I say they were not gonna show. You will see them when we'll be doing the SPL here. Like you will see the part of the interest. On the other side, it will be an income. On the other side, it will be an expense. So along the way, they contra account each other. So it's like at the end, they are eliminated. There is no need to show them because on the other side is an income. On the other side is an expense. So that's why I say, since you eliminated them here, there is no need to show them in your SFP.
Thank you.
Okay. Precious. Question? Precious. Okay, Precious is recording and sleeping. Pikashe?
Hi, no question on my side. Thank you.
Okay, Petunia? Petunia? Okay, Peggy?
I'm covered for now.
Okay, Nokubonga? I can't hear you, Nokubonga. I can see that you want to talk, but I can't hear you. If you have something, maybe you can write. We'll be able to take it one on the chat box. Mpo?
I'm fine for now.
Klapiati?
So far, so good, sir.
Okay. Mary?
Can you kindly show the interest received and interest paid part again?
Okay. And then Jabu. Hazel. Okay, I assume the others, they are fine. Then let's go back to the interest part. I want to know which part do you want to understand? You want to understand the elimination purpose part, or you want to understand the individual section of each journal before they go to the group? I will need you to respond because I don't. I can't hear you properly. Repeat the statement. There's a breakup. Jabu. I didn't get your question properly because there's a breakup on the, I think the signal or something. Maybe if you can try to type it on the chat box, then I can revert back to it. But in the meantime, I will continue while you are typing the question. Now we're gonna go back to the statement of profit and loss because it's what needed now. On the statement of profit and loss, we've got we have to do our gross profit part. From the pre-adjustment statement of profit and loss, we are given the values as for 484,680 and 326,300. However, those values, they were somehow including the profits, or they are excluding the profits, because remember, there were profits that were realized during the year as a result of selling the inventories to the people, and another inventory being sold to the outside group, to the people outside the group. So now let's do the calculation of our gross profit, which it will be the statement of profit and loss. While I'm busy tackling the part of the statement of profit and loss, I will request that question so that I can able to clarify the part of the interest. So on the statement of profit and loss, we're going to start from the gross profit. And as I've shown that this gross profit is somehow it includes the profit unrealized and the realized profit during the year as a result of the transaction number 2. Because on the transaction number 2 and the 3, there were things sold. So initially we know that inventory affect our cost of sales. So cost of sale at the end, it's going to affect our gross profit. So the transaction number 3, we're going to affect our gross profit. So,
Sorry.
Okay, yes, I'm listening.
I want to ask about, like, to take it back, maybe it's because I joined late. I want to find out if maybe like on the exam, they said draft a statement of profit and loss. Do I need to submit the analysis of owner's equity as well, or I must only submit the statement of profit and loss?
In most cases, it depends on the question who's selling who. If, for example, in this case, our analysis was required, the reason being we've got the subsidiary who was selling the assets to the parent. Suppose all the information we've given in the adjustment is all about the parent selling. So it means, and you are also required to draft the statement of profit and loss. There is no need for you to draft the analysis of owner's equity for the subsidiary, because all the transaction is all about the parent. And suppose you are given the situation whereby there is no transaction of whoever selling to whoever, and you are required to draft the SPL alone. So there is no need to draft the analysis of shareholders. I don't know if I answered your question, because mostly the analysis affect the transaction which they are done by subsidiary towards the parent.
Okay.
Yeah. So first of all, you have to check the information given so that you can decide whether you have to draft the analysis or not. But if the required says you must draft the statement of financial position, so in that case, you don't have a chance. You just have to draft your analysis of shareholders, irrespective of whether they are transaction of the subsidiary or not, because there will be certain things from your NCI which you need to show them on the statement of financial position. So let's continue again with our statement of profit and loss. So as I said, on the gross profit, we've got the 484,680 and the 326,300. However, there was a movement of inventory, and we know that inventory affects the cost of sale. And as a result of affecting the cost of sale will also have an impact on the gross profit. So we have to do a calculation for that, for the gross profit on our side. So our calculation for gross profit gross profit, we have a given figure which is for G Limited, which the given figure for G Limited is sitting at 484,680. And then we have another given figure for our L Limited. Which is sitting at 326,300. Now we've got the unrealized and the realized profit, because Mr. G decided to sell his inventory to L Limited. So since G sold the inventory to L Limited, on the opening balance of the inventory for L Limited, it means Mr. G will realize a profit. And then on the closing inventory of L Limited, Mr. G will have an unrealized profit, because at that point, the inventory is not yet sold. So we're gonna, on the opening balance, it will be a realized profit. So the realized profit will come from the opening inventory of L Limited. So which it will be the 210 multiplied by 50 divided by 150, which it gave us that amount of how much? The 70,000. So this 70,000, it will be now representing the realized profit. But since it's a realized profit, you have to add it back. That's the reason it's added. You will see on the summary that I made, because I will request you, like, if you want the summary that I made, I will share the numbers that you can join the group, and then so that you will text me. You said I just want the summaries of the transactions. Then I will send you via email. It will be best to get it via email because it's in form of Excel. And then now we're gonna have the unrealized profit. So the unrealized profit is based on the closing inventory, because the inventory is sitting in the books of L Limited. And at that point, L Limited didn't sell the inventory to the public. So it means he's still sitting with the inventory. So in the books of G, G didn't realize the profit yet because he will only realize the profit once the inventory is being sold by L Limited towards the people outside the group. So we have unrealized profit, which it will come as a result of the closed inventory, which L Limited have of 315. We multiply by the 50, we divide by 150, then it will be the 105. So this 105 so the 105 will be deducted. It will be deduction then our closing when we add this together, they will give us an amount of 775. Okay. 775,980. Then our 775,980 will be regarded as our gross profit on our statement. So we have 775,980. Then we proceed further. We've got the other income. As remember, here we are presenting it according to IFRS. So if you remember, for those which they did FAC2601, we've got in the presentation of the statement of profit and loss, we've got the gross profit, then we've got the other income, then we've got the distribution cost. So here it will be gross profit. We have a other income. Then we have the distribution cost. We have the administration. And then we have the operating. Then from there it will be the finance cost later. And the finance cost. So you must present this according to this format of IFRS. So because here you saw that they give you a gross profit, the other income, then the expenses. You're not gonna present it one by one. You have your gross profit, you have the other income, and then now you have the depreciation as a one-line item, staff cost as a one-line item. No, you have to amalgamate them because you're gonna present it according to the IFRS method as per required. So now if we have a gross profit is 775,980, then we're gonna have the other income. Our other income, we have the interest received of 35,750 and the 12,500. And then remember on this 35,750 plus the 12,500, there was an interest received as a result of the loan made by G. G lent a loan of 150 to L. So since L was paying an interest of 150, so that interest, it need to be deducted from this 35,750. Then on the other income, we can put it like this. It will be the 35,750. You add it with 12,500, which is the one for L Limited. Then we have to less that interest which was paid by L Limited. So remember, when we're doing our journal, we have that interest, which the interest payable by L Limited of 15,750, it will be an interest received on the books of G Limited. So you have to less it here. You less that 15,750. And then you can close the bracket. So it means here we'll be having an amount of 68,500. Let's validate it. 35,750. You add with 12,500, and then you minus the 15,750. Then you have to add the admin fees received. The admin fees received of 24,000, and then plus the 12,000, the one for L Limited. And you will have that 68.5 thingy, then plus 4, 1, 2. Then we have the 68,500. I guess everyone is super there. Then from there, we're gonna go to admin. Remember, we are following the format. Here we have a gross profit, we have the other income. We don't have anything shown as a distribution cost. We jump it. Then we go to administrative expenses. So our administrative expenses, it came as a result of the depreciation, the staff cost, the auditor's remuneration, and the administration fees paid. So note those things. Depreciation is admin expenses. Staff cost is admin expenses. Auditor's remuneration is an admin expense. Administration fees paid, it will be the admin expense. So we can only focus on those one. The interest paid is not forming part of the admin expenses. It's going to go to the finance cost. So our admin expenses will be $158, which is the depreciation. Then you add with 134,400. Then because G Limited acquired a machine from L Limited, there was a depreciation as a result of the realization during the current year, which must be subtracted. If you remember, I did show you this. Let me share it again. Just hold on. Depreciation, selling depreciable item. So since our subsidiary was selling depreciable item, when we treat this on our admin expense, because we have given the admin expenses, I mentioned that the realized depreciation. So the realized depreciation will be based on the profit which was made versus the year which was used. Because if it was used for the 12 months, so we're going to realize the depreciation for that particular 12 months. So the realized depreciation on the profit will be deducted from the admin expenses. So since we have the admin expenses, so whatever we're going to realize on that 50,000, we must deduct it, which in this case, it will be the 10,000 part. So as part of the notes that I've drafted, I said it must be deducted on the face value of our statement of profit and loss. And I mentioned that only if the admin expenses is applicable. So if we don't have the admin expenses, so there is no need for you to deduct that realized depreciation. So let me go back to my normal screen, the one for working. And share the current one. So here we're gonna have the 158,000 plus 134. Then we have to less the 10,000. The 10,000 came as a result of the 50,000 profit multiplied by the percentage on the depreciation. And since it was for the whole year, because it's the depreciation realized during the current year as a result of G Limited using the machine. This is based on what I did in the beginning, this part. It will be based on this part, this portion. That this 10,000 is the one which you want to deduct it here. So we deduct the 10,000. This is the portion of deducting that 10,000. Then we're gonna add it with the 60,000 of the staff cost. Then we add it with the 48,000 of the staff cost for the subsidiary. Then we add with the 12,400 for auditor's remuneration. Then we add with the 8,600 for the auditor's remuneration in regard of the subsidiary. Then we add with the 12,000 for the administration fees paid. Then we add with the 6,000. Then we can close the bracket. Therefore, the amount sitting here, it will be the 429,400 as an expense. Then we have, as part of, we take the gross profit is done, other income is done, distribution cost is not there, admin expense is done, operating expenses is not there. Then we're gonna go to the finance cost. Finance cost. Okay, this amount will sit here, cut, paste. Then finance cost. On the finance cost, we have the 28,500 from the parent plus the 24,650 for subsidiary. Now we have to less. There was an income received as a result of the finance cost for an amount of 15,750. So this 15,750 was paid by it was paid by L Limited. So it's an elimination. So we must deduct it again. So we can say minus 15,750. So this goes back to the question which was raised by Tandeka, if I remember very well, whereby she was asking about the part of the loans. So if you can check based on this question, if I don't put this 15,750 here on the other income, then I must not also put it here on my finance cost, because by that case, it means it's out, because here is in, here is out. So at the end, it doesn't have any impact on my SPL because it was eliminated when we were doing the, elimination journals here. Okay, it was part of the elimination, so it doesn't have any impact. So Here you add it, you add, and then here you're gonna subtract it, so it doesn't have an impact. So we have an amount of for the finance cost.
That
Sorry?
15,750 up there.
Mm.
We add it or we minus it, because I see it's like you minus it. Other income.
On the other income, remember,
Yeah.
is the reason we minus it here is because it's an intra-company account. It came as an income, which the income come from who? From one of my subsidiary. You get me? So since now we want to do the business without the intra-group transactions.
Okay.
So the same applies. Here is the finance cost. We minus it because it's the reason being is the intra-group transaction. As a result of this, it was interest payable by L Limited. However, on the income, it was interest receivable by L. Here it was paid by L. Here it was received by G.
Okay.
So since
But
it's an intra-group,
on the
so
other income, it's like you minus it.
yes,
so we minus price.
It's minus because I want to remove it. It must not form part of this other income, because
Okay.
it's not other income from people outside the group. Other income from the people within the group.
Okay.
And on the and then on the other side, on the finance cost, is the finance cost paid by the people within the group. That's why we have to deduct it, so that we can only show the finance cost paid to the people outside the group. Because here we want to show the finance paid by the people outside the group, and here we want to show the interest received outside the group, or the income received outside the group, not within. The one within, we are taking them out.
Okay, I get it.
All right. So here we're gonna have the finance cost of 37,400, which it will be form of the minus. Then we followed our rule here. So the only thing left, it will be the income tax expense. So we're gonna have a profit before tax. The profit before tax will be sitting as 171,808. So that is after taking into consideration of this. You add whatever need to be added, you subtract whatever need to be subtracted. And then it will give you the profit before tax of 171,808. Then you have income tax expense. Which it will be both for the groups. Subsidiary parent paid an income tax of 141,412, and then okay, sorry, here should be 177. Why? It's 377 here. 680. Then we have the income tax expense of 141,412. Then we add it with the one for subsidiary, which was 64,460. Then our income tax expense to be deducted, it will be sitting on the 205. It will be sitting on 205,872. Then when we do our profit for the year, the profit for the year will be the 377 minus the 205, which is sitting on 171,808. Okay, then we can go to the SCE. So the SCE, I'm not gonna draft it together with the profit before tax note. I'm not gonna draft it that much. I'm gonna just be explaining. So the profit before tax note, this one is just the easy marks to collect. Like the profit before tax arrived after taking to the following account, and then you mention that in the income, this is how you arrive on the income, and then on the expenses, this is how you get your expenses. Then you just get those full marks. It's the free of charge those marks because it's based on whatever was happening on your question, on your statement of profit and loss, together with the any information before the adjustment. Then we got the statement of change in equity. So since the share capital of the subsidiary was eliminated, now we're going to only focus on the share capital of the parent, because the one for subsidiary was eliminated when we were doing the pro forma journals as per page 158. That portion of the share capital retained earnings, revaluation surplus, goodwill was the elimination of the share capital of the subsidiary. So that share capital is now gone. We only focus on the one for the parent. So the parent have a share capital of 200,000 as shown on the statement of change in equity as per page 151. On 151, we have a share capital 200,000. So you're gonna that take further and put the 200,000. There was no any other shares issued during the year, so you can close it as 200,000. Then we go to the revaluation surplus. When we check the revaluation surplus initially on the books of L Limited, it was sitting at G Limited was sitting as 80,000. So there was no any other revaluation done during the year because the one for subsidiary was eliminated in the beginning when we were doing the revaluation. The 120 was eliminated using the acquisition part. So we have a revaluation surplus of 120. I mean of 80,000 because it's the one for the parent. The 120 was eliminated using the at acquisition method. Then we have the retained earnings. Our retained earnings for the parent, it was sitting on 224,690. So on the 224,690, that was the balance at the beginning. Remember, you had the minus of the retained earnings, which was sitting on the negative part when we were doing the analysis of shareholders. So on the analysis of shareholders, we have the retained earnings sitting on the minus, which it was the 54,000. So that 54,000 now must be deducted. You don't add it because on the prior sections, we used to add it because it was on the positive figure. But since now it's sitting on minus, we have to deduct the 54,000. And then again, there is a 70,000 minus. The 70,000 minus, it comes as a result of the profit realized. Remember, you have the realized profit. As I mentioned, that the retained earnings need to be deducted here. You have the realized profit of 70,000. So that realized profit need to be taken off. I guess everyone is understanding me here because you realize you had the unrealized profit before, but now, as a result of the opening inventory, because now the inventory has been sold, so that opening part of that inventory, it's going to affect the retained earnings on the books of the parent or on the books of the consolidated, because now the inventory was sold to the public, so then the profit is now realized. So since the profit is realized and it affects the retained earnings must be deducted by that profit realized of 70,000. Then we have the total of, it will be the 386.90. Then from there, we go to the movements during the current year. So the movement during the current year, it will be the profit for the year. He, as the parent, realized a profit of 132,118. So on the profit of 132,118, it must now be added with the profit realized by the subsidiary during the current year. So the subsidiary realized a profit of, let's see, on 132, 118, we add with 132, 118, you're gonna add with the Profit realized during the current year of 59,752. Um, 156,870 less 132, 118 is 24,752. The profit realized during the current year, we have the 171,808 from our consolidated statement of profit and loss. So now we have to check the one attributable to the parent and the one attributable to the non-controlling. So the one attributable to the non-controlling, it will be 4938, which comes as a result of our analysis. It comes from here. So you're gonna say the profit realized or the profit maintained by the group of 171,808, you less the 4938. So the 171,808 minus the 14,938. So the 156 will be the profit attributable to the parent, which is the one that's gonna go to your retained earnings on the statement of changes in equity. That's why you're gonna have that 156,870. Then you do a total of 156,870. So the non-controlling, it will be the 4938, which comes from your analysis, and then the 43,300, it comes from the balance as on the 56,800, you less the 13,500, which comes from here. You're gonna less this 13,500, then that will be the end of your statement of changes in equity. So I want to know if there's anyone who have question with regard to this question 2. It can be anything, whether the profit, the interest, the how to tackle the inventory. So I will just be tackling the questions here. Any question?
Hi, Mr. Molepo.
Yeah, Bo.
I have a question in terms of a scenario where the current asset would have been sold in the current year.
The current asset.
Yes.
The one which is depreciable or non-depreciable.
The depreciable one. How would we record that?
Okay.
Because I realized that we did record the 10,000, but yeah.
Okay. In a situation whereby the current assets are sold in the current year, for example, give me a scenario: who is selling to who? Parent selling, subsidiary selling. Who is selling in your context?
Okay, in the current scenario where the subsidiary is selling, if G Limited had sold the asset in the prior year, right?
Yeah.
To L.
Yeah.
Had then the asset been sold outside of the company now?
Okay. On this question, we've got current assets of whereby the L Limited sold the machine to G Limited, ne?
To G,
At 200,
yes.
at 200,000 now.
Mm-hmm.
And then now you wanna know, suppose G Limited sold the machine outside the group.
Yes.
Okay. If suppose it happened that G Limited sold the machine outside the group, so the same 50,000, the profit which was realized by unrealized profit, which was maintained by L, it will now become a realized profit. So you saw that we deducted the 10,000, ne? So that deduction of the 10,000, it will no longer be minus 10,000. We're gonna minus the whole 50,000. The reason being, the asset itself, the whole asset was sold to the person outside the public. But in our scenario, in this case, the reason we minus 10,000 is because the asset was not sold. So we still have the asset on the books. So we only minus the 10,000 being the depreciation part, because the asset is being used on a month-to-month basis. So the 10,000 came as a result of the asset being used for the whole year. I don't know if it makes sense today.
It does make sense. Would we then account for the 3 months prior to that, which is that
the portion of the 3 months, the one starting from 1 December 2006 to 28 February 2007, that one was on the prior year. That's why you saw on our analysis, you see on our analysis of shareholders, this profit, this part, this, it was on the prior year. It was not on the current. Suppose, let's test this question. Suppose this was sold on 1 December 2007. Ne? Suppose the question now was saying, on 1 December 2007, L Limited sold the machine with the carry amount of 200,000 to G Limited at a profit of 50,000. Now, our 2.5, it was not going to sit here. Instead, it was going to come here. Here, we're going to put the 2,500 here.
Okay.
You get it? Because now is the current year. So it means, again, then when we draft our statement of profit and loss, you see that portion of 50,000 times 20% on the administrative expenses. We were going to say 50,000 times 20%, then times 3/12, because the 3/12, it will be the usage by G Limited during that month, 3 months.
Okay.
Yeah.
Understood. Thank you.
Okay, another question. Anyone who have a question with regard to the selling of depreciable assets, the selling of non-depreciable assets, the revaluation within the group, the selling of the inventories as part of this study unit number 7. Because remember, there is no way that you're gonna write an exam for FAC2602 without study unit number 7. Any question that where a person needed clarity, or you will need the clarity at a later stage when we'll be treating the tutorial letter? I guess so. Okay, any question with regard to the module itself up to so far? Starting from learning number 1 up till 7. Okay, I guess there is no question. Next week, we'll be treating the situation whereby we are now declaring the dividend, either subsidiary declaring the dividend or the parent. It can be the ordinary, it can be the preference shares. Where are they dealt? Dividend during consolidations. And then okay, the preference shares will be done on the legend number 9. And again, you won't write any module, you won't write the exam without the learning number 9. So the learning number 7, 8, and 9 are the key for this module. So if you master them, then I will say you are in a good chance to pass this exam. And since you'll be writing an online exam, it won't be that much difficult because you will still having the study material with you somewhere, somehow. Because I think the treatment of the tutorial letter will be dealt somewhere in the towards the end of September, towards the beginning of October, somewhere, somehow. Because we checked your exam dates. They are now final and they are still sitting on the 26th of October. So at least we are lucky they didn't shift the date to the earlier date. So we are still fine there. So we have still enough time to tackle the study guide plus one of the questions from the tutorial letter. So next we will be treating the study number 8, the dividend part, which will be more focused on the ordinary dividends. And then after that, we're going to tackle the preference shares. Then it will be the cash flow of the groups. From my side, I can't start the new question. I mean, a new learning unit because we are only left with 9 minutes. So the 9 minutes won't be enough for tackling the unit number 8. That's why I'm asking anyone to ask questions. And if you want to join the group, please notify me so that we can tell you what needs to be done in order to join the group. That's the end of the class for today. Whoever have a question, you can raise it here, then I will tackle it. If you want to join the group, you'll also notify me. So we'll meet again next week. One will be tackling the learning number 8. Okay, Precious, I want to join the group. Precious, you just send me a message to this number and mention that it's Precious FAC2602. Then I will know that you want to join the group. I'm sharing the number here. You can chat. You can check on the chat box. So you send. You're gonna send the WhatsApp message. So you indicate your name, and FAC2602. Then I will know that you want to join the group. That's the only thing to do. You send a message to the number shared on the chat box, then write your name and FAC2602. Then I know that you want to join the group. Then you will take it from there. That's it from my side. So Nogubonga Hazel Memory, you just send the message to 0724535744. You write your name and the code FAC2602. Then I will allocate you to the group. That's the only thing to do, nothing else.